Hey guys, welcome to my video discussing market structure and how to basically find the trend, whether that be bearish, bullish, and how to basically identify higher highs, higher lows, and lower highs. Now, in my opinion, this is the most important part of the beginners module. The reason being is because identifying lower highs and lower lows or higher highs and higher lows is really the main part of Forex trading. Now, we need to first identify the overall trend on a higher time frame basis, really right down from sort of the monthly, weekly, down to then the daily, 4 hour, hourly. Now, what a lot of traders seem to get mixed up with is that when they begin to go down on the smaller time frames, such as the 4 hour, the 1 hour, they begin to see bullish price action. So, for example, they begin to see higher lows and higher highs, which tells us that we're in a bullish environment. But what they fail to understand is that on the higher time frames, such as the daily, weekly, and the monthly, we're actually very bearish. So they begin buying and buying, and then eventually price collapses. Normally quite a lot. It normally collapses quite a lot to the downside, and that's because they fail to establish the overall trend on a higher time frame. So it's very important that we always begin our analysis from the monthly and the weekly. Now, generally, I don't tend to look at the monthly very often. The reason being is because there's only 12 monthly candlesticks within a year, so they're not very frequent. They're very rare, so I will check them when a new month rolls over. But most of my analysis is always beginning, usually from the weekly time frame. So what I will first do is I will go to a blank chart, whether that's GBP, JPY, which is what we're on now, or Euro USD, and I will begin from the higher time frame and I will try and establish whether we are bullish or bearish. Now, the way we can distinguish whether we're bullish or bearish is we simply find whether we're making lower lows and lower highs, or higher lows and higher highs. Now, you can see on this example here that we were in a downtrend. Now, a downtrend is when we're bearish, and bearish is basically meaning we're looking for reasons to sell. We're not looking for reasons to buy this at all on the higher time frame. We're actually looking for reasons to sell. So what you'll find is that price will move quite some distance to the downside. It will stop, for whatever reason. Maybe it's hit, a psychological level or number, which obviously is covered within one of the other videos, or it's hit some previous support or something that was once resistance and now support. But either way, we're not too fast as to why it stopped. All we know is that once it has stopped, we've now formed this new lower low, which is obviously what's happened here. So because we know that we're bearish on the higher time frames, we would basically be looking for then a retracement, because price can't just keep dropping. Can't just drop. It has to retrace, it has to rest. We have to see some relief to the upside to then have a continuation to the downside. So these are called retracement legs. Okay, so we get a large price action leg to the downside, and then we get a retracement price action leg, and then a continuation to the downside. So what will happen is it will be bearish, and then it will be temporarily bullish, because this is just a slight retracement, a slight rest phase to pick up more sellers. And then what will happen is we'll form this new lower high, and then we'll continue down to make a new lower low. Now, when this sequence breaks and the trend actually changes, is when we come down to create this new lower low, and then instead of coming up to create a new lower high, which has to be lower than the previous lower high, in fact what we do is we create this new higher high. Now, when we break this structure here, and we form this new high, that is when the trend begins to change. So then naturally what will happen is then we get this retracement. So we get this bullish price action leg to the upside, which took out this previous lower high, formed a new higher high, and then again this retracement. We wouldn't sell this because we're now within bullish price action. So we're only now looking for reasons to buy it, because we're basically bullish on the higher time frames. Okay, so therefore we would never sell this. We would just wait for it to stop, wait for the retracement to finish, and then we'd buy it up towards the next high. And again, we then have a retracement down. We wouldn't sell this because that would be us going against the trend that we've identified from the higher time frame. Okay, so therefore then we'd buy it when it shows us that it's stopped. And then obviously there's other things that we can use within this, for example, Fibonacci retracements, moving averages, market structure, things like that. But obviously this is just the beginner's module, so we can go over all, using fibs and market structure and things like that. So, how to plot support and resistance, trend line application and stuff like that when we get further along. But the idea is just to remember that the trend changes once we break this lower high. Once we break this and create this new high, the whole trend changes and we now become bullish. Now, obviously, we're bullish, and then what happens is we create this new lower high. Now, what should have happened is we came up like this, came down, and we should have then come up to form a new higher high to continue the bullish price action. But obviously, we failed to do that. We couldn't, for whatever reason, get above this most recent higher high. And actually what happened is we formed a new lower high. So we began breaking this sequence, and then we came down to create this new lower low, which took out this most recent bullish price structure. Now, when that happens, now we can confirm that basically we can now expect a new lower high. So therefore, we wouldn't be buying this because obviously the trend has now changed. We would be selling from here down to create a new lower low. Okay, so this is the fundamentals of lower lows, lower highs, higher lows, higher highs, and it's very, very, very important that we always find this on the higher time frame from a top-down analysis, because as I said before, when we begin scaling down to the daily, the 4-hour, the hourly, the 15-minute time frames where there's much more noise, a lot more price action within these legs, what can happen is that, for example, if we were zoned in on just this price action leg here, so say this is the weekly time frame, if we go down to the daily, what's happening here on this price leg here is we're actually forming daily lower highs and lower lows. So if we just stuck to the daily time frame, we never looked at any other time frame, we would convince ourselves that because of this price leg here, what we were doing is creating lower lows and lower highs. So we're thinking, oh, this is bearish, but actually, if we scaled out onto the weekly, we could see that we are actually bullish, and this is just a retracement. So we can't get too confused with the lower time frames. We always need to find the trend on the higher time frames. Okay, so the trend is not entirely broken until we break the most recent swing point. Okay, so what happens is let me just remove some of these lines. What happens when we create these new higher highs and then these new high lows, higher highs, higher lows, all these swing points become either support or resistance. Okay, so let me just clean this up a little bit. So what happens is these points here become, this is now resistance, support, resistance, support, and then we've got obviously another support here, and these become price, these become support and resistance, supply and demand levels within the market, which we'll cover in another video. But basically what we can do is we can remove all these, and we can begin marking support and resistance on our charts like this. This is a line here. Okay, now these become support and resistance. So this is resistance, this is support, and then what happened is as we broke through this previous resistance and this previous lower high, we then created this new higher high. And we came down to hit support, which was at this point resistance. We used that as now support, and we came up, broke through this previous resistance and formed this new high. Came down, found support at a previous lower high swing point, bounced from here, and then came up and create this new high. So we can now use all these swing points as support and resistance to help provide extra layers of confidences and protection when we're using these levels to buy and sell from. Because the idea is that when we're in a bullish trend, where we're creating these swing points up, down, like these zigzag formations, is that we always want to be buying at the best value. Now obviously when we stop here, this would be the best place to buy, not here. We don't want to buy at the top, we want to buy when we get the retracement. So that's why we have to wait patiently for price to come down, retrace, stop, and then we want to buy from here, come up to here, sell, and then obviously buy from here, come up, sell, and then come down, buy, sell, buy, sell. And then when we break it, and obviously we break this sequence and we fail to make a new higher high and we create this new lower high, we want to then sell it and then wait for the retracement. Sell it, wait for the retracement. Sell it, wait for the retracement, because now we're in a bearish sequence. Now what I'm going to do is we're going to go down to the next thing. Now, on the weekly time frame, what will happen is that we will be in this sequence, this bullish sequence, as you can see here. So we're going to buy it from here up to here. Okay, now obviously selling would be counter trend trading. We're going against the trend, but you can then sell it from here to here and then buy it from here to here, sell it from here to here. I personally wouldn't encourage you to sell it from the top down to here to the retracement, because obviously that is against the trend. You're better off buying it from here, selling it from here, as in closing your position, your original buy position, waiting for the retracement, and then buying it again, closing your position, waiting for the retracement, buying it again, and then closing your position and playing it like that, because then that way you're never really trading against the overall trend. So, that is the safest way of doing it, because the odds are therefore in your favor, because the trend is your friend and you want to trade with the momentum of the upwards direction. Now, this is a weekly time frame. Just for argument's sake, this is what you would see. Obviously, these would be candles, not a line. And what will happen is that within these price action legs, because these are all price action legs. So from here to here is a price action leg. From here to here is another price action leg. These are all legs. Okay, 1 leg, 2 leg, 3 leg, 4 leg, up, down, up, down. Okay, now within these legs, these weekly time frame legs, there's opportunities within this. It might just look like a straight downward movement, but actually when you go down to the daily, you'll find that it isn't, just a straight downward movement. There's actually swing points within this. So there's swing points within swing points and more legs within legs, if that makes sense. So if we look at this leg here to the downside, which is this leg here, which is a bearish selling move to the downside, it's a retracement to then go higher. This is the box zoomed in. So this is the leg zoomed in. Now, if you go down to the daily, the weekly time frame is bullish. It's making high lows and high highs. But when we go down to the daily time frame, the actual daily time frame is bearish because it's making lower highs and lower lows. But the weekly is still overall bullish. Therefore, we are creating smaller bearish swing points and bearish price action legs within the larger bullish sequence. Now, I cover this in the more advanced part of the course, where we speak about fibs within fibs, about how we can use, sort of bearish fibs within a larger bullish fib, or sort of a smaller bullish fib within an overall bearish fib, to find overall targets. So although on the daily time frame, this looks like it's bearish because it's creating lower low, lower high, lower low, lower high, lower low, lower high. Actually, all this is just on the bigger time frame, it's just a retracement. So yes, we can sell from here to here, and then we can sell from here to here on the daily time frame. But we just have to be aware that all of our analysis always has to begin from the higher time frames. So although we're selling this on the way down, so we're selling this leg on the way down, we have to be aware that obviously we are still bullish on the larger time frame. So therefore, what could happen here is we could sell, up, sell, up, sell. But then what's going to happen is we're going to meet this point here, and then we're going to bounce. So what's going to happen here is this is our zoned in box. We're going to then bounce like this. So we just have to be cautious of the fact that we're always aware of the higher time frame and making sure that although we are selling or buying it, that the actual overall time frame, we're going with the trend always. Now, I can see that this is bullish on the weekly, so therefore I'm taking extra precautions when I scale down to the daily, 4 hour and hourly, and I'm remembering that even if I'm seeing bearish price action on the daily, 4 hour and the hourly, that the overall structure is bullish. So therefore I have to take extra cautions when I'm trying to sell this, because I have to treat this as just temporary selling of a bigger overall bullish and buying picture. So what can happen is that you can be bullish on the weekly, bearish on the daily, but actually bullish on the 4 hourly. Okay, so say for example this is daily, and then this is our zoned in leg. So this is our leg here of price action on the daily, which looks like just a move to the upside on the daily. Now when we scale in onto this part of price action, just this leg here, and we go down to the 4 hour, what we can see is we're creating higher lows and higher highs on the 4 hour. So therefore the 4 hour looks bullish, but the actual overall daily is bearish, but then the weekly time frame is bullish. So therefore what we can do is we can buy these little small retracements. So we can take these little day trades where we're just in and out within a day, and we can buy it from here to here, and then we can buy it from here to here. But we just have to be aware of the fact that all this is here, all this price action is here, is just this leg. Okay? And all this is here is just this leg. Okay, so everything looks different on different time frames, but the most important thing to remember is the fact that we're always going with the overall trend on the higher time frame. This is bullish. This is temporarily bearish whilst we're coming down to hit this point here. And then this is temporarily bullish, but obviously the weekly is bullish too. So this is safe to buy this because we're always buying with the actual overall move. Okay, so just remember that on the weekly time frame, the legs on the weekly time frame, within those legs, there's a lot more to be said inside these legs. All right, so when you begin scaling down, the biggest advice I can give you is make sure you're always checking, always on the higher time frame, to confirm whether you're making high lows and high highs or lower lows and lower highs, and that you're trading with the overall trend. Now there's different ways of trading. Obviously there's scalping, where you're kind of in and out the market for sort of 20, 30 pips. You're not looking to gain too much. You're a high frequency trader. So that means you're taking multiple positions per day or per week. And then there's day trading, where you may hold the trades for sort of like a day or two. You're looking to gain more than 20, 30 pips. You're looking to maybe gain sort of 50, 80 pips per position. And then there's kind of swing trading. Now, when you're trading off the weekly time frame, and you're buying from say here to here, this is a large move. It's a very large move. Okay, so therefore, if you're buying from here and you're holding because you're looking to make this higher high because you've already confirmed you're in a bullish sequence, so therefore it makes logical sense to anticipate a new higher high because that's what's happening, then technically what you're doing is swing trading, because this move here could be sort of 600 to 800 pips to the upside. So this is kind of for swing traders. It's for people who don't want to, place multiple positions during the week. It's for people who prefer to place, a smaller amount of trades, but look to take a larger amount of pips out of the market. Now, swing trading is the most profitable because, it's called swing trading because although this leg here is a large move to the upside, these are the swings, the smaller swings. So therefore, the price never just shoots up. It goes like this. It goes up, down, up, down, up, down. So therefore, you're swing trading. You don't mind the fact that prices are retracing slightly to then go further up, because on the bigger time frames, such as the weekly, you're actually swinging it right up. Now, swing trading is the most profitable because you can just practically take the position and just sit in that position for long periods of time until it hits target. And then you've got day trading, which is obviously on this time frame here, where you're taking a much smaller amount of pips, maybe sort of 50 to 80. You're taking more frequent positions, and you're in and out of the market a lot more frequently, but you're still not taking as many trades as a scalper. Now scalpers generally on sort of 4 hour, hourly, so they're doing these smaller moves. Day traders are doing these sort of bigger moves, and swing traders are doing even bigger moves. So swing trading is less work. It means you can have less time within the charts. A lot of your analysis is really on the higher time frame. Your entries are still, your actual entry is on the smaller time frame, but your overall analysis is on the higher time frame. And you're placing a lot less trades. You're spending a lot less time on the charts, and it's just kind of generally easier money if you're going with the trend. Day trading requires you to have more time on the charts, to frequently be checking the charts sort of every day, to be doing a lot more analysis, and you're dealing with sort of smaller time frames. You're still using the weekly to find the overall trend, but you're generally on sort of smaller time frames such as the daily, the 4 hour. And then scalping, you're generally on sort of the 4 hour, 1 hour, 15 minute. You're in and out of the market, lots of times during the day, maybe 4, 5, 6 times a day, and you're just kind of grabbing these little moves up, little moves, and you're trading a lot more frequently than other people. Now, scalping, in my opinion, is the least profitable. I'm not saying that it's not profitable at all, but the reason being is because you're placing such a high volume of trades, you run the risk of trades going more against you. And generally what you'll find with scalpers is that they're trading both with the trend and against the trend. So they're trying to catch both moves both ways. Obviously, this course itself is, it caters for scalpers, day traders, and swing traders, but it's primarily focused on day traders and swing traders. But there is a day trading example where the strategies and the techniques that I teach also apply to scalping. So the strategy and the technique that I teach within the advanced part of the course can be applied to the smaller time frames as well, such as the 15-minute, where you can just get in and out of the market for 20, 30 pips. Or you can apply the same technique to day trading or swing trading. So the great thing about this is that this can be used on all different time frames, for all different kind of targets and gains. But going forwards, if you're looking to actually live life and not be sort of fixed to the computer every minute of every day, then I would highly suggest to go down sort of the intraday day trading road, and sort of the swing trading for maximum gains. Now, if we go down and look at GBP, JPY, and we just identify the trend, together, what we can see here is we were very much in an uptrend here. Okay, we were in an uptrend because we're going up, so we're going up, down, up, down, up, down, and we just kept going up and down, up and down. And then what happened is we actually broke this, okay? So we broke this most recent high low. Now, once we broke this here, and price fell below this and closed below this, we could then confirm that the whole sequence has now changed. We're no longer bearish. We're no longer heading to the upside, because what should have happened is price should have come down like this, like it did, and then bounce, taken out this most recent swing point, create a new high, down, up, but it didn't. What actually happened was it broke this and it changed the entire sequence. Now, I believe that this particular time was something probably to do with Brexit, because we had quite a large collapse to the downside. Now, what happened is we did actually form this discrete sort of lower high, came down, lower low, lower high, lower low, lower high. But let's just kind of focus on this part here. So when we create this lower high, we then came down to create this lower low. So we're still very much bearish. And because we're bearish, we're looking for reasons to sell it, not to buy it. Okay, so any retracements up, we're looking to sell it. We're not looking to buy the retracements up. We're just looking to sell it. We're looking for reasons to sell, not to buy, because we've established that on the higher time frame, we are bearish. Okay, so then what happened is we came down and created this new lower low. And then what should have happened is we should have come up to create a new lower high below this lower high and continued the bearish sequence like this. Come up, sell, lower low. Come up, sell, lower low. But that did not happen. That didn't happen on this occasion. What actually happened, if I just clear this up quickly, is on the higher time frame, the weekly, we actually had this large bullish price action to the upside where we took out this most recent lower high. And we actually formed this new higher high. So now suddenly the bearish sequence that we were once in it no longer exists. We're actually seeing bullish price action on the higher time frames. So then generally what happens is when you create a new higher high, you would then expect to create a new higher low, which is what happened here. Then you come up, create this new higher high, which is kind of this point here. Come down, higher low, higher low, higher high, higher high, higher low. And then what happened is we failed to break above this point here. Okay, so we came down like this, created this new higher low. Great, this is a good buying point, buying point, buying point, buying point. And then what should have happened is we should have come up to create this new higher high, but we failed to do that. In fact, we couldn't break this most recent higher high. So therefore we stopped. Okay, we stopped and then we formed a new bearish candlestick, and then it started looking like we were going to roll over. Now at this point here, once we had these points, the first thing I suggest within the rest of the course is the moment you've got 2 points of anything is to connect them up with a support resistance line or apply a trend line. Now we could have applied a trend line to these points here and actually seen that when it created this lower high, we were probably going to then potentially create a new lower low. And that's what we did. We created this new lower low, lower high, lower low, lower high. Now, as long as we can stay above this kind of area here, ignore this wick because this was a large wick on a flash crash. I'll explain flash crashes further along in the course. But as long as we can stay above this point here and we don't break below this, we could then see this come up, take out this lower high, create a new higher high, come down, higher low, and then we could start looking bullish. Or, alternatively, what could happen here, and I don't know because obviously price hasn't happened yet, but going on the basis of the trend that we're in, which on the weekly time frame is bearish because of the lower highs and lower lows, what's probably going to happen here is we're actually going to break down like this, take out this most recent lower low, and form a new lower low. And then we'll come up like this, retrace, create a new lower high, and we may even be able to draw some sort of trend line on this. Form a new lower high around the trend line here. And then we'll come down to create a new lower low. Because obviously we're in a bearish sequence. Now, as long as we don't break this most recent lower low, this could be a trend reversal. And this is the thing, we always have to be on the lookout for price to change, for price for trends to reverse, because we always have to anticipate the turning points, because the turning points of a trend can be the most profitable. For example, if you'd recognize this trend reversal here where we failed to make this new higher high above this one, then you could have sold it from here, from this very point here, and actually swing traded it all the way down to where it is now, which actually is 1,500 pips. Massive, massive move. A huge move. Very, very rare that traders get these kind of moves and this amount of points within a trade. In fact, if you'd actually got out at the bottom of this flash crash, it would have been around 2,300 pips, which is insane. Going on the basis that most traders on average make maybe 100 to 200 pips per week, this is a massive trade. So it's very important that we always anticipate reversals within an overall trend, because at the reversal point is the most profitable. Now, something that we can use within, to try and find the overall trend and reversal points is something that I will discuss further along in the course, especially when you begin learning about Fibonacci and support and resistance, trend line application, things like that. But I will give you a quick example now. Now, the way you can determine a trend change is like I showed you earlier on today. So what I'm going to do is I'm just going to clean this up a little bit so it's a bit easier to understand. Now, when we're within this sequence, high, 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 low, high, 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 low. Now, these swing points become support and resistance points within the market. Okay, so let's just plot these levels on together. So we've got 1 point here. Okay, Now you can see that this was resistance, resistance, resistance. We broke above this resistance, and then old resistance now becomes support. So when we break resistance, generally what will happen is we'll come back down, we test the resistance, and then it will be treated as support. And this is what happened here. So this was resistance, resistance, resistance. Price was resisting against this and struggling to break above it. When we did break above it, finally, and we created this new higher high, we then used this original resistance as a level of support. And we actually kept bouncing and bouncing. It became a level of protection to drive price higher. Now, once it became support, what we can then do is use this as a level of resistance. Okay, so therefore what should have happened is we should have then bounced from here, came up, and then used this previous resistance as then a level of support to then bounce from, and then create another higher high. Okay, and then use this previous resistance as support to then come down and use this as support. Okay, but obviously what happened here is this original resistance, it remained as resistance because we never broke above it. Okay, and we actually formed this new swing point. Now, when we form this new swing point, this now becomes also a barrier of resistance too. Okay, now it becomes a barrier of resistance. So all swing points become barriers of resistance or support. So look, you can see here we've got support, and then we've got support here, look. And every single swing point becomes either resistance or support. And then we've got, look, support here. And then we've got resistance here. So now we're starting to pinpoint all these points. Okay, so we needed to break this resistance to create a new higher high to then carry on the bullish sequence. We didn't. We came down and formed this new lower high. This is what happened here. Now, another way we can find reversal points, not just if they don't break support resistance, but actually fib levels as well. Now, in one of the other videos further along in the course, you'll begin understanding Fibonacci much better. But if you know a little bit about it now, I'm going to show you another way as well as how you can find reversal points within the market. Now, what you can do is, although this is bullish price action, so therefore when you're using a fib on bullish price action, you're only ever doing the fib this way round. See, this is a bullish fib, this is a bearish fib. So bearish fibs are going from this swing point to this swing point, bullish fibs are going from this swing point to this swing point. Now, really, when you're in a bullish sequence, you should only really be using your fib this way round. Okay, this way around like this. So you go from this swing point to, say, for example, this swing point, waiting for the retracement, to then go long up into the extension target, which sounds a little bit complicated right now, but you'll understand this as you go along. Now, but what you can do within a bullish sequence is you can actually use your fib the other way round. And on the fib level ratios, the 78.6 Fibonacci level is actually the last point before the fib is invalidated. So therefore what you can do is every single time price stops like this, you can fib it the other way around. And let me just remove this. And as long as price stays below the 78.6, you know that potentially this could be a reversal in the trend. Now, this sounds a little bit more complex, and obviously, as I said, you're going to learn about this further along within the course. But you can use the 78.6% Fibonacci level as the last point of invalidation. So, therefore, you've got two levels to get through here for this to continue. You've got the 78.6, and you've got this resistance. Now, as long as you can break above the 78.6 and you can break above this, then it's very likely that you're going to then create this new high. But if you're struggling with 78.6, then it's very likely you're probably going to fold. Okay, so it's very much like it's very much the same way around as well. So let me just remove this. Now you can see here, for example, if you go from this lower high point here, this swing point, from the top of the wick down to the most recent lower low, as long as you stay below the 78.6, it's very likely that this bearish sequence is going to continue. Very much like the selling pressure is going to continue. Okay, so as long as you can stay below here, and you can stay below here, then it's very likely you're going to continue to the downside. So you can actually use the 78.6 and the most recent swing point as benchmarks and levels to ensure that you stay below these levels to maintain the bearish pressure. Now, obviously, if price actually came up like this, you still need to get through this recent point. Now, as long as you stay below this recent point, you'll still remain bearish. What could just be happening here is you could just be coming up from this double top and then rolling over. But if price breaks up like this and has a body closure above these, then you can confirm then that you've created this new high, and then what's going to happen is you're going to come down like this and retrace, and then you're going to head high and the whole trend is going to change. But just remember, you can use the 78.6 on the fib as the last point of it before invalidation, before you can use these as to plot levels to stay below almost. So you can use like a bullish fib on a bearish sequence to figure out last points of reversals. Okay. Now, just to go over one last thing with this, as we confirmed earlier on, we are currently looking at the weekly time frame. Now, on the weekly time frame, for example, here we are bullish. Why are we bullish? Because we're creating high lows and high highs. Now, we have to remember that within these price action legs, like I was explaining above, there is selling opportunities within this. If we went down to the daily time frame on this here, and I show you quickly, let's go down to the daily and just look at this box. Although we're bullish on the weekly time frame, what we might find is that if we were just on the daily time frame, we would think that we're bearish, and that would be us forgetting about the higher time frames. So let's go down to the daily and just look at this bit of price action. Okay, so as you can see on the daily time frame, we're actually creating lower low, lower high, lower low, lower high, lower low. So if we were just focusing on the daily time frame, we would think that we're bearish. We would think, okay, yeah, great, this is bearish. We could use our fib tool and fib it from here to here, and we can see that we stay below the 78.6. We're bearish, so therefore we're looking for reasons to sell it. But actually, we're forgetting that because we didn't analyze it using top-down analysis and look at the weekly time frame, that this wasn't really bearish price action. This was actually just a temporary bearish and a selling pressure to then create a new bullish, larger leg. So as I was saying earlier with regards to scalpers, day traders, and swing traders, a swing trader would be buying this from here and riding it all the way up to the top. So he won't mind about these retracements. He won't mind that he bought it from here, was in really good profit here, and then lost most of the profit, came back up, was in really good profit, came down, lost most of the profit, came up, was in even bigger profit because he's swing trading all of these swings. Whereas a day trader focuses on these smaller legs. Okay, so we've got a leg here, okay, and then we've got a leg here, and we've got a leg here, and then we've got a leg here. So day traders who want to be in and out of the trade within 2 or 3 days would be taking these trades here. Okay, and then what would be happening here is scalp traders would be going into this bit here. So let's now go down to, say, the 4 hour and the hourly. Okay, so now this is the 4 hour time frame. Now if we were just focusing on just this box here, we can see that we're seeing bullish price action. And if we were just trading off the 4 hour and we completely disregarded the daily time frame and the weekly, we never even looked at it, and we were just focusing on this, we would be thinking to ourselves, okay, got a buy here, sell, buy, sell. But then what happens is then the whole thing collapses. And then the reason why the whole thing collapses, and this is why it's not safe just to trade off one time frame and disregarding the higher time frames and distinguishing the overall trend, is that you could keep buying and selling this, and then bang, it completely goes against you. You didn't foresee it coming because you weren't looking at the higher time frames. So this is kind of what scalpers do. And then you've got even legs within this. So you've got even, just this leg here, this one leg here on the 4 hour. If you go down to the hourly, there's loads of opportunities within this too. You've probably got hourly legs where it goes up, down, up, down. So there's legs within legs. And all I'm saying is that make sure you identify the overall trend on a higher time frame first before getting too caught up and mixed up with the smaller time frames, depending on what kind of trader you are. If obviously you want to be a day trader, what you can do is you can do these larger moves in, out within sort of 2 or 3 days. Swing trader, no need to worry. You just buy it straight from the bottom. Don't worry too much about these retracements. You just sit in it and sit in it and sit in it and go with the trend. And obviously, if you want to be more of a intraday scalp trader, you can scalp these little moves. But all I'm saying is scalp trading, day trading at times can be dangerous if you haven't first identified the overall trend. Now you can find that by just simply trying to look for higher lows and higher highs, or lower lows and lower highs. So first of all, make sure you always remember to do top-down analysis from the monthly, weekly time frames right down through the time frames. And some traders like to actually swing an overall position for sort of 800-900 pips, and then between all those legs within legs and the swing points within swing points, they take sort of shorter intraday and day trades to fulfill their other side of their personality. It's all to do with your own personality within the market. It depends what kind of person you are, whether you're somebody who quite likes to be active within the market, multiple times per day, or whether you're somebody who actually just wants to sit in a position for maybe 2 or 3 weeks. I hope you guys have found this video helpful. If you have any questions about identifying lower lows and lower highs, or higher lows and higher highs, then feel free to give me a message.